Welcome to Investors Hangout once again. And this is a day before our 73rd Independence Day. And this is the 125th episode of Investors Hangout. It all started uh, with the whole idea of, helping you attain financial independence. And Builder Sun Life Mutual Fund help us initiate this. And then we have carried on 125th episode is quite a landmark for us. It's quite a milestone. And today I'm going to talk about, of course, all the issues of or all our discussions on Investors Hangout has always been about helping you or answering your question or the contextual thing, the burning question that you have at any point. We are trying to address which, anytime you become curious or anxious about the question, in that context, we have been there every week or sometimes or every other week to tell you about how to deal with it. Whether it be noise, whether it be basic, whether it be turmoil, whether it be a rising market, whether it be a falling market, whether it be the crisis around debt funds, we have been around to tell you how to go about, how to deal with it, making sense of it, how things work, so that you carry on your journey of financial independence with full confidence. So today we are here on this special episode 125th, and with me is Mr. K.S. Rao, who also, who actually made it happen. We were little unsure of, our video initiative and can we do it, and he just had the patience of driving us to make it happen. So thank you, Mr. Rao, for joining us on this special occasion, 125th episode. And this also happens to be a special thing that, first digital version of Samriddhi, a magazine which started uh, to empower investors with essential financial knowledge, essential, helping investors gain same objective, financial independence. And it all started with, when Indian Railways wanted us to produce a magazine which they can give it to their audience in a limited way on Shatabdi trains. So tell me how it all happened.
Hi, good morning to everyone. Thank you, Dhiren. Thanks for having me here. Indeed, it's an honor and pleasure to be part of Hangouts. And congratulations to you and the entire team for this making the 125th episode. I think it's a phenomenal task. The consistency of managing 125 episodes is it's a marvelous work. I think kudos to both the teams and great. We are all grateful to you for phenomenal work you did for us and.
No, thank you for having the belief that we should carry on.
Yeah.
Uh, I would like to know how this Samriddhi thing started.
Samriddhi is a personal finance magazine which has started way back. I think it's almost 4 years now. It's for the Indian Railways, which we discussed earlier, and it's launched by it's a proud to have a Union Minister for Railways. I think the then Minister Mr. Suresh Prabhuji has launched, and this is for specifically for the passengers of. Shatabdi trains, and it has gone such a long, and so far it has covered almost 25 routes and 50 more than 50 lakh passengers. And the magazine tagline you says it's a path to prosperity. And today I look at there is like and its whole intention is to teach to I mean let the passengers read something which can make their journey prosperous. And today, unfortunately, because of the COVID situation, I mean there is nothing. I mean we will relaunch once the train starts, but I thought it's better we can have a digital version where a lot of us at home, why should not we learn, and this digital version can be more useful. And last but not the least, the previous editions too available on the website if somebody would like to download. And truly, it's a Samriddhi. It's a path to prosperity. In fact, in Vedas, there is a word which called for money. It is called Suvinyogat Samriddhi. When you utilize your money appropriately, it gives you the prosperity. I think true to the label, I think Samriddhi has come out well. But I thank you and your team to support us in this initiative, and we are always grateful to you.
No, it has been our pleasure, and I think we have been, being able to reach out to a large audience with essential background or foundations of getting started. or how to approach investment. Saving is good enough. Saving is a good starting point, but how to go about investing for prosperity. And I think it is a small step in that direction. In fact, if we have been able to provoke some people to think about it while they are in the relaxed context of their travel, and they are reading it, I think we have succeeded. Being able to reach out to such a large audience, looking for that opportunity. Of course, it looks like it's disrupted for now with the traveling, trains being disrupted, services. But I think this online thing will democratize it further. And use the link, give your feedback, and tell us how how you find it.
Sure, I think it will come out definitely well, and hopefully this magazine will be utilized by many of the people. And earlier it was reaching only to the passengers in Shatabdi. Now it can reach to many who are at home. They can read and yeah. And then I think the Samriddhi is something called prosperity. And why can't we have today's conversations also around Samriddhi? How we can, there is other way around, is a financial freedom or financial independence, and we being celebrating the Independence Day, and most of us will talk. Today, the financial independence has become a buzzword. How can I think we can extend our conversations around financial independence in this hangout session?
We have been talking. Investors Hangout has always been about empowering investors for financial independence, and we have taken a very different route in terms of reinforcing. Sometimes I wonder that are we talking the same thing? But I think we need to talk the same thing in different ways in the different context, for the reason that it requires reinforcement. I don't think we can come up with too many discoveries and inventions around how to invest better. The method is the same. Uh, Accumulating enough money, being regular with your savings, investing your savings because saving is not good enough, investing in a manner that you are able to beat inflation, that is real return, and how to go about doing it in a disciplined manner. And this requires reinforcement because you have, lot of anxiety coming from the environment, whether it be the markets, whether it be about your career, whether about your changing circumstances. You can do a lot about, few things which is in your control. But most of the things around personal finance, which causes anxiety, which causes greed, which causes fear, and extreme greed and extreme fear, you don't have a control on that. So that is why the message requires, the whole lesson requires constant reinforcement. And this to some extent, at Value Research as well, and Investors Hangout has been a very dominant way of late in a couple of years, where, a lot of people are averse to reading, but they are fine with, listening to things. So it has actually been a changed medium for us. And I think, going by the number of people who have seen these videos, comparing these videos as compared to most other videos on the internet, the amount of time spent by people in on our Investors Hangout archive is quite phenomenal. On top of it, I find that we we do this interaction, or we communicate every week, but we find that many people actually go and look at the archives, and looks like they are still relevant. They're relevant most of the time. So I think the whole message for investors is that you have to be disciplined, you have to be regular, but at the same time you need to constantly remind yourself to stay on track, because staying on track in these times, or the very noisy world we live in, is going to be very difficult, and it helps you do that.
Very true, Dhiren. I personally feel the post-COVID era, most of the people are impacted with the money, either with the job loss or with the pay cuts, and it's costing a lot. But sometime back when I was starting this function at a financial education, I was just looking at. I think financial wellness is the right word we always should talk about, because now on the COVID side, one, you need to have a immunity. There's a physical wellness. wellness, and other side we have a financial wellness. And I was designing some curriculum way back on financial wellness, what kind of things we can do. This, I think, I recall it could be a 2014 or 15, and there are something like it comes into your 5 buckets. It's a, I mean, when we were launching the programs, the first programs we launching was something called a financial literacy, where somebody can have a understanding the basic knowledge of the investments, or about the money itself. Then we have created programs kind of financial capability.
Yes.
Financial, that's the second bulk called financial capable. How you are using these products, mutual funds for your investments, and how you can change your mindset right, and how you can get it right. And the third one was the financial secure. How you can become more secure with the money which you are investing. What is that? How you can get there, and the financial independence and the financial freedom. But financial freedom is always something like choosing the family over finances, and spend your time on your interest. You have a lot of money with you. You managed your wealth well, and you have a job which you are enjoying, or which is sufficient. I think that way the goal is to be a financial well-being that leads to the financial freedom. What do you suggest, Dhiraj?
We have been talking and reinforcing all the basic financial concepts in terms of how to save, invest, and stay on track. But all this was fine in normal conditions. This this crisis last 3 4 months, and uncertainty about the world we live in, the businesses getting uh, such great uncertainty about our jobs, our careers, the financial markets, and everything. So that has actually brought about the whole new realization that complete realization. I have come across people who never thought of investing or savings, or worrying about their investments scattered all around. The people who were not doing anything, they have become conscious of it. They understand that now they have to really worry about it, not say uh, when I used to say, write in a column that best time to invest was 20 years ago, and the next best time is to, today. But then that today will always get extended to tomorrow, and tomorrow never comes. That tomorrow has come today. Now people are realizing that no, they have to do it. So the urgency, that driving this urgency, I think the people's own experience has been the biggest learning. The people who had their investments scattered all over, collection of investments, not much worried. Uh, they have gone about reorganizing their investment, rethinking in terms of are they all right, all the basic concept that they learned, but they never implemented it. So the people who had inertia, they have got started, or they are at least, there is a urgency there. The people who had their investments and they knew all the concepts, all the framework, they have gone about rejigging it. There are people who now, who are comfortable, but it requires a change of track. Their circumstances have changed, their conditions have changed, so they need to really replan it. Uh, we at for invest even in investors hangout, with the number of questions that we get, is quite large on some of the basic concepts. So and these concepts might would have looked very sophisticated concepts 5 years ago, in terms of how to rebalance, how to have the asset allocation, how to go about setting your asset allocation, how many funds to have, how to diversify better. I think a lot of people are asking those questions time and again. What looked like very sophisticated is becoming a mainstream question. So I think in a partial way, we have we are well on track. Unfortunately, the most of the results, cows will come have home, many years later. So, but when people are doing it with understanding, I think they are more likely to stay on course. It is not going to be a knee-jerk reaction for them, and that is where the learning helps. And I think we are partially contributing to the evolution of this whole thinking about financial independence, which will be sustainable.
I really congratulate you, Dhiren. I myself reading value research insight over last 2 decades, and definitely when I started reading, and from now, I think unknowingly, probably it may not be those terminology which we use, the financial wellness, or healthy living through active pursuit of financial knowledge, or creating a planning, or creating a goal setting. All these things have become an auto mode, and it has become a part of the life as you read every month on mutual fund insight and getting that. And that has truly given me the holistic approach, honestly. And those tools which I use even today, I was telling some time back, some of those my partners in smaller towns, they use your magazine as a reference point, and I'm sure they contributed to the financial well-being of themselves and lot many clients around. When kudos to the great work. But all said and done, you are right. In the current scenario, post-COVID world, everyone need to be serious, and one need to take their finances very, very seriously. This is a time you need to look and where we are and where you want to go and how your finances. I think true financial independence, somebody to celebrate is look at your finances seriously, because most of us, we would have neglected, we have not bothered about, we have not put the things around. And though hangout side you spoke many a times, but it is all of us need to go back and go to the drawing room and see how you are managing your finances and what is that you are doing very differently now. And I mean, last time you were talking about, I think you spoke many times about contingency fund and emergency fund. And if any
Yeah.
one of them followed today, probably there are no regrets, right? Now people are very serious how they can do things and how they can attain. And there's a lot of queries are coming around that.
Yes, in this investor hangout, the 125th episode, I would say that we have been guilty of repeating the concepts, and I think the basic concept which remains is the four bucket system which everybody should follow, because if you don't follow it sequentially, all your plans will go haywire. And the four bucket system is building a foundation, which is if you have financial dependence, have your life insurance, adequate life insurance, liberal estimation of if you are not around, how much does your family need, and go and buy
Yeah.
your term insurance before you start investing. Then comes health insurance, because if you don't have the essential health insurance, little bit of health issue and all your savings or investment plan will go haywire. Once you have this, then have the adequate emergency fund. Emergency fund, we have been talking about it, but nobody actually had it, because everybody was very assured of their cash flow coming, whether it be their profession, their job, or their business. Uh, this crisis has brought about great deal of urgency around the emergency fund, that how much is good enough, which you should be handy, the money which should be handy at all times, and it should not be dependent on the environment or anything. So emergency fund, how much is adequate? We have talked about it so many times, but at the same time, and there isn't a formula. Don't look for an expert. Your life insurance coverage estimation is not is you are the best person to estimate that. You are the best person to actually estimate the emergency fund, because you can have the most objective assessment of what emergencies can arise. Old parents, young children in family, you have a different context. Uh, Likewise, how uncertain is your career, how unsure of you are of your job, or what is the likely cut, or if you're in a government job, doesn't matter, you can carry on. So those kind of things, you are the best person. So spend some time thinking about it. Once again, I'm reinforcing this concept, and then comes critical goals. First should be you know uh, your two goals which most Indians have. Everybody has to retire, and having enough money on your retirement so that you don't run the risk of outliving your savings is one. The other is that you should have enough for having enough resources for child's education, and that is a changing that's a changing target, that's a moving target. It's not possible to estimate it 20 years ahead, but still it is better to err on the side of caution, have little more than enough, do a liberal estimate, and start planning. Time takes care of it. And working on your retirement and once you get into that phase, and the basic and uh, having adequate resources for your retirement. And let me tell you, a lot of people think that they will come to me, they will ask me, and I will give them some suggestion, and that will make things happen. It is not that. You are going to be one of the biggest driver of your financial success, because you have this best estimate. Be staying on course, being disciplined about your investments, being disciplined about your allocation, being disciplined about your investment, and being disciplined about your disinvestment. uh, we talk about it all the time. The SIP became a very mainstream way of investing for many Indians in the last 10
Right.
years. And disinvesting, before you need the money, plan your disinvestment with SWPs. work on your SWP before after you retire, because letting your money remain invested and having a withdrawal plan of a methodical kind is crucial. Also, one concept which has time and again been reinforced in Investors Hangout is why equity is crucial. Because fixed income can get you safety. Fixed income is crucial, is important, but fixed income will not get you growth. It will not get you the buffer. It will not get you the uh, margin of safety. And when you have more time, you should be, uh, you should have as much in equity. And only once you have accumulated something meaningful, when you should try and de-risk yourself with a larger allocation to fixed income, uh, so that it is not dependent on the state of the markets for your overall financial well-being.
Very right there, and I think very appropriate. I really see every time when you are reinforcing those basics. I think we need to get that internalized, and this is a time which has already given a reminder, a wake up call for us. I agree. Whether you define it as a financial freedom or independence, even your retirement planning, you need to relook at every time, and more so in the COVID. I was talking to someone. I said it's like if I'm using my GPS to go to my office, while
Mhm.
starting it has shown 30 minutes, but after in between that has rerouted me and it has taken another 45 minutes. Effectively it is 1 hour
More
15
Bangalore.
minutes. And more so in my no, but this rerouting has happened when I started the GPS. I think the whole positioning, the accident or something would have happened somewhere is not factored in, and that
Yes,
accident got
absolutely.
factored,
Absolutely.
then you have rerouted to some route. Similarly, in your personal life, this COVID is an accident which has happened. You need to reroute and take a different route, and it can take little longer. Probably that is what I say. For your financial freedom, one need to work, but keep in mind. When you achieve financial freedom is few things. One, your wealth covers your lifestyles and expenses, and making money is not a priority for you, but it's it's the money is already available. You live your life the way you want to live, and you attain the highest. I think that's where financial knowledge plays a vital role, and you attain this financial knowledge, and you are mindful of your spending decisions, and you are financially free when when you are using your time for what you wish to do and how you wish to do. I think this Independence Day one has to reiterate how they can do that financial independence for them. What is the independence for them? But I was reading some numbers about financial independence. Can you explain to the audience or the viewers of this show what is that financial independence number and how it can be calculated, and how one need to get that? What is my independence number, my financial independent number? There.
It depends on person to person, because your lifestyle, your cost of living is entirely a personal issue. But and so you are so one is that estimating clearly that how much you, because financial independence means being able to live with dignity, uh, and not outliving your investments or not outliving your savings till you are alive. Uh, even if it amounts to not leaving a large estate for your successors, but at least this much is essential. For this, I think we have come up with a very simplistic formula in terms of, think of it in terms of, if you retire tomorrow, how much money you are likely to need, and your retirement corpus, where you must have accumulation from any sources, or you should be working hard, you should be ensuring that you have your savings accumulate. And for that, I think if you start early, most of the problems, time takes care of the biggest problem, because you will be able to invest in equity over a longer period of time will generate superior return. Fixed income will not take you there. If you have very large savings or income, maybe, but it will not grow well enough. So in that sense, having equity for the long term and accumulate that much, having a 4 to 6% withdrawal rate, to our understanding, as of now, given the context of inflation that we have lived in, given the kind of interest rate outlook or inflation outlook that we have, 4 to 6% withdrawal rate, 4% for a more conservative allocation, and 6% for a more aggressive allocation to equity, will make sure that you don't outlive your investments, you don't outlive your savings. So this is a simple formula. Most people can actually plan their retirement with their, because any retirement is, a lot of people have this misimpression that they have to invest in a specific product which is labeled as a retirement product. No, any financial product, any investment that you have made, and you remain disciplined that you will not fiddle with that money. You will not, you will not spend any part of that money. It is meant, it is a sacred amount. That is something which you will not touch at any time. Is your retirement corpus. And on your retirement, if you have any amount of which 4 to 6%, ranging between 4 to 6%, can be withdrawn, will be good enough to support your income requirement in retirement. And that I
Well,
think is financial independence, because being able to live with dignity for a lifetime.
yeah. I think very rightly put it, Dhiren. I think two simple steps: how much you are spending and how much is your safe withdrawal rate. Probably the post-COVID, one need to analyze your spending rate itself has come down, right? It's like I personally feel healthy now. You can have a healthy savings account, and it's like your essentials and unessentials you can differentiate today, and that way your spending rate has come down. Unfortunately, your withdrawal rate also will come down because interest rates, everything has come down, and one need to rebalance. That's where the financial independence number will come. And I personally feel, when we can talk, when you are financially free, is like so you do things you want to enjoy, and you have enough corpus for you, and you create a passive income streams, and you have a diversified assets, and you have allocated assets into the various portfolios. I think one need to look at. I mean, but I'm always distributor advisor friendly. I always tell people that have an advisor so that somebody can work for you. You can't do on your own. That's yes, Dhiren.
Undoubtedly, undoubtedly, many a times we are, because advisors do play a very important role. We just have too much. Investing is a very difficult job, because in early stages of our career we have low earnings, and we have infinite, the economic problem that we have too many needs which has to be fulfilled. So somebody helping us, get out of this inertia and initiating us to investment is a great job. At the same time, somebody coming here and coming to Value Research, listening to Investor Hangout, being interested, I think they're in minority. There are a lot of things, which happens in the market, and most investors or most savers tend to go off track. So if you are able to find a good advisor who can help you stay on course, help you do all these things efficiently, undoubtedly he could be the much needed professional that you need, because most other professional services that you engage with, they are quite straightforward. They are quite contractual. They're quite transactional. Whether it be chartered account, of course they all require intimate understanding. But here is somebody who will actually become a repository of your behavior, who will become, and if you are able to find somebody who understands your behavior, he will be there at the right time. When you get very anxious, he will be a bouncing board of that idea, that what you need to do. Your changing circumstances, you can think about how to fulfill your needs. So yes, an advisor could be useful, and if you are unable to empower yourself with the learning.
But I think a lot of tools which you have developed on the value research, I think it's definitely helps people. But I still feel one definitely need to be independent. You need to be a financially literate. You need to become financially capable and financially secure. Have your own financial independent number, independent, be financially independent. That leads to financial freedom. And with this, Dhiren, I think there are a lot of questions from the audience.
Yeah,
Shall I take the questions, or would you like to
yeah,
say
yeah.
something? Yeah. Okay, and Dhiren, here is a question. The first question comes from Ankush Jain. He says, I am currently servicing three loans, and it's a home loan, car loan, and loan on my credit card. The collective EMI amounts to about 40,000, and I often feel burdened because of it. Can you please suggest a strategy I should follow to free myself from this burden of debt?
uh, no strategy will help, because you have already spent, all the loans that you have taken is actually amounting to consuming your future income. and that is happening, I will have, I can only suggest you that somehow, whatever it requires, whether you do take up a part-time job to earn more, get rid of the credit card loan. It's the most expensive loan, and any investment will never be. And if you're making investment, stop your investment and get rid of this credit card loan. Credit card loan is not worth taking ever, except for some emergency. If you landed in a hospital with your child, and then you need to use your credit card, and that credit card bill you are unable to pay, sure, that is the only time when it justifies being used, taking the credit card loan. Then get rid of your car loan, because this is, one has to really decide. The principle that the only loan which can be justified is the home loan, because this is a long-term asset, it appreciates, and if it is saving your rent, that's the only thing which justifies. But so my strategy is very simple. If you have any investment or savings, immediately prepay your credit card loan, try and accelerate the repayment of the car loan, and carry on with your home loan only. And if you don't have enough income to support this, then think of doing whatever, part-time jobs to increase your income, whatever, enhance your income to get rid of this. Otherwise, you will work, and you have already spent your future income. You will never be well off. This is a recipe of remaining poor for a lifetime.
And then it's a fair answer. And Ankush, I'm sure you will be repaying your credit card debt first, which is a high cost debt. Then you can take over other things where you can plan your finances well. If you can, first you can get out of the high cost debt. I think that's where it's the biggest pain, and you pay highest. I think it's a fantastic answer from Dhiren. Dhiren, this is the second question comes from Mr. Bharat. It says, is a thumb rule to know what proportion of monthly savings should be allocated to different goals like retirement, child education, buying a house, etc.?
No, there is no thumb rule, and there can't be a thumb rule, because it entirely depends. Uh, how young is your child, and when he is likely to go for his higher education, when you need the money. So there is a time frame which will be different. What kind of education he goes for and how expensive it will be, one doesn't know. What kind of house and when do you plan to have it? Of course, that is a negotiable thing. You can have your house in 5 years or 7 years or 3 years, depending on your circumstances. Also, at the very root level, at the very basic level, it can't be done. There can't be a thumb rule, also because one doesn't know your income. If you're earning 50,000 rupees in your initial stay, or some stage of your career, and you are able to barely save 10,000 rupees a month, it's different. uh, but everything changes, your income changes, and we are growing old by the day. So in that sense, it entirely depends. All the parts that you have, child's education, the components of that, house, the kind of house that you want to buy, your income and your savings, because these are all very personal things. There can't be a thumb rule. I think the basic thumb rule should be that, save as much as you can, and having a little
Yeah.
more, uh, save as much as you can, say invest as much as you can in equity, the money, for all the goals. Don't even define your goals, have these goals in your mind. Have as much money invested in equity, the money which you are unlikely to need for next 10 years. Uh, and a 1 or 2 cycle of the market itself will give you enough confidence to, plan things more finely as you get closer to your goals.
That's phenomenal. Save as much as you can and invest it rightly, and make your goals as a priority and invest according to your goals. I think it's a great answer. This is a question from Rohit. I'm 35-year-old and plan to retire early by the age of 45 or 50. How should I proceed?
uh, the initial discussion we were having, uh, just do an estimation of how much money you need every month to make a living, with dignity and a dignified living, and do that estimation. And then you'll be able to figure out how much you need in a year's time, and make sure that you have enough capital, which is 4% of that money. So assuming that you need something like 6 lakh rupees a year, to retire, and that should be good enough. And if you are able to build a corpus of something like 1 crore, it'll be fine, because what you need is that is 6%. Having little more will actually give you a greater cushion. Uh, I think so. This is the simple formula which you should follow, and that's 1 crore that you will have accumulated in a equity, in a mix of equity and fixed income, and a combination of fixed income, which will be, it could be scaled up with your public provident fund if you have it, or senior citizen savings scheme, and then fixed income fund up to 30-40%, and remaining in equity, because even in retirement, the general understanding is that when you retire, you become risk averse and you should not be in equity. That is not true. If you are not in equity, and if you have to live for, because you have to plan for, if you retire at 45 or 50, then you have to plan for next 30-35 years of living, which will be supported by your income from investment. And for that investment to be able to beat inflation, it must have a reasonable or a sizable uh, equity component. So I think, having a corpus of 1 to 1.2 crore to support that, that is just for illustrative reason, and also for ease of mental calculation, that I have given that large number of 1 crore or 1.2 crore. But that's the plan that you have to implement.
That's good, Dhiren. Thank you so much. And this question comes next is Suresh Patwardhan. He says, I am 65 years old and retired. My bank FDs are earning less now. Should I be investing in debt funds? If yes, what kind of debt funds would be suitable for me?
Uh, I think, somebody who has never invested in a market-linked investment, it is not easy. So I would like him to start with, but I like him to start with short-term funds. But before that, one should really do a very basic estimation that, do you depend on this fixed income or fixed deposit for your income? If you depend on fixed deposit for your income, you need a different plan. If this is money which provides you financial security, but you don't depend on them, you just want that money to grow nicely, safely. If that is the orientation, then I would like you to have to get little venture sum, in the sense that put 80% of your money in fixed income of a conservative kind, which will, there are two advantages of it. One is that the income from fixed deposit is taxable. Income from fixed income fund is not taxable till you withdraw it. So if this money is going to remain there, it will earn little more than fixed deposit, and you will not be liable for any taxes till you withdraw it. If your holding period exceeds 3 years, the long-term capital gains tax will be applicable, and that tax rate is substantially lower than the, that way all the interest income being clubbed to your income. As it will be taxed at marginal tax rate, and every year having 20, 25%, 30% into equity, if you are not going to depend on these investments for income, is desirable, because that is the best way to beat inflation, or at least match inflation. Because in coming times, the fixed income return, whether it be from fixed deposits or fixed income funds, will not be able to, will be barely able to match inflation. So your money, psychologically, you will be comfortable that your money is growing, your money is safe, but it is not actually growing in growing in value in real terms, because you invest 100 rupees today and it becomes 105 rupees, and next year your income, all the things that you spend on also requires, your income to rise. So you need two different plans, depending on whether you are going to depend on these investments for income, or it is just for your financial security, to have it handy in a safe manner.
Yeah, thanks, Dhiren. And this next question comes from Mr. Arvind. Arvind says, how many mutual funds should I have in my portfolio? Does investing in any of these mutual fund types as possible further to de-risk my money? I do have surplus of 20 lakhs to invest. Where do I invest?
Okay, yeah, you must invest. I think more importantly than how many funds, it is important to spread your investments over time. If 20 lakh rupees is a very sizable part, you know, uh, if it has taken, many years for you to accumulate this 20 lakh rupees, or this has come from any one-time, sale proceeds of any asset, then you should think in terms of spreading it over, 15 months, 18 months, 2 years time. That is crucial. That is very important to de-risk your investment and also build confidence in market-linked investment. Because the moment you invest 20 lakh rupees and markets the way they are and they are likely to remain like this at all times, uh, it can actually be very disturbing for anybody who is investing for the first time. So that's one. Spread your investments over a long period of time so that you are able to de-risk from yourself from catching a market high. Then comes, how many funds? Uh, Two or three, and diversify. The reason is that diversification is crucial. So invest in two, three multi-cap fund, maybe two or three, and maybe one international fund. That will get you adequate diversification. That and two, three multi-cap fund from different fund managers, because it will also de-risk you from the different style that different fund managers have, which undergoes some kind of cyclicality. Some fund managers do well at some time, some fund managers don't do well at some time. So two, three fund will be good enough, and spreading your investments is important to spread your risk.
Yeah, that's a very detailed answer, Dhiren. This is a question coming from Pradeep Sonavane. I'm investing with a horizon of 7 years. What should be the asset allocation, and how frequently I need to change, or when it should be changed?
Uh, you don't need to change. I would say that an asset allocation of 75% equity, 30, 65 to 75% equity and 35% debt will be good enough for 7 years. I think it's important that you carry on with one or two balanced fund. You won't have to worry about the rebalancing or changing allocation yourself. More important will be when you need the money after 7 years, and if it is a non-negotiable goal, you definitely need the money, and after 7 years, then maybe carry on with this investment for 5 years and start withdrawing. Do a systematic withdrawal plan and put that money in a fixed income fund, a conservative fixed income fund, in the last 2 years when you need the money, so that you are not dependent on the market as and when you need the money.
Thank you, Dhiren. Thank you so much. And this is a question coming from Mr. Satish Kalanji. And is it advisable for a retiree to invest in an arbitrage fund?
Arbitrage funds have come on the forefront because market became very turbulent. Arbitrage opportunities did exist, and the charm of an arbitrage fund is that for a 1 year holding period, it gets you the treatment of equity funds, which is no longer as beneficial as it used to be. But I would say that most investors can do without investing in arbitrage fund, because recently it looked as if some arbitrage funds were giving better return than fixed income, with the added advantage of being treated as an equity investment for your investment of 1 year and more, which in case of fixed income fund is 3 years. But I would say that short-term debt funds can actually fulfill that need better. And if you're a long-term fixed income investor and you want your money to be invested conservatively, which is not dependent on or which is not exposed to the stock market risk, then those are relatively more stable. In some situations, arbitrage funds have actually fallen short of. Of course, they are pretty safe in the sense of they don't take equity risk. They are structured and designed in a manner, but there are times when arbitrage opportunities don't exist in the market, in a range-bound market. There has been occasion in the past when arbitrage funds had to be, they got classified and they had to conduct like a liquid fund. So the fallback of the arbitrage fund is that they will turn into a debt fund if they don't find enough arbitrage opportunity. So I would say that keep it simple. Don't try to be tactical with your optimizing little more return with such a thing for your large part of the money. A small part of money can definitely be invested in arbitrage fund for the short term.
Yeah. Thank you, Dhiren. I think it's a lot of questions. Before I handing over to you, I request viewers do download the Samruddhi magazine, which is the link is available, and you can come to the either at a VR website or at our website at Aditya Birla Sun Life mutualfund.com, and where you can get this downloadable available to you. And as you celebrate Independence Day, I wish each one of you also celebrate your financial independence, become financially secure, have a plan, have a purposeful investments, have a right saving strategy, And of course, always join Hangouts to upgrade your learning skills and knowledge skills on the mutual funds. As Dhiren said, to one of the viewers, one of the questions, pay off your debt. I mean, then avoiding this lifestyle to creep on. And to get it multiple income streams, have your right financial plan. And over to Dhiren for this Hangouts. Thanks, Dhiren, for inviting me here for the 125th episode. And I look forward this Hangouts can reach out to the larger audience. And great to be part of you.
Thank you, Mr. Rao, for being here and asking me the questions and giving your inputs. All our visitors at Value Research Online and everybody watching Investors Hangout, do share your thoughts or if you ever came across Samriddhi magazine while traveling in a Shatabdi train. I look forward to it. Other is that, download the next issue, the digital issue, and look at the archives. You might find it interesting. This 125th episode of Investors Hangout is quite a milestone, and we look forward to serving you with answers to a burning question that you might have every other week. So thank you very much for being with us. We look forward to having you once again next 2 weeks from now again. Thank you.
Thank you so much. Happy Financial Independence Day. Thank you so much.